Following what has been a turbulent period in the markets heading into this week, all eyes were on economic data spanning inflation to retail sales to the labor market. What did the data points reveal, and what does it mean for the prospects for rate cuts as we look ahead to September? We will break it all down for you with our senior economist from the UBS Chief Investment Office, Brian Rose, right here on UBS Trending. Hi everyone, welcome to UBS Trending. I am your host, Dan Cassidy. Brian Rose is here back in the studio to break down the latest news on what is going on with the economy. So Brian, it's great to be with you here at the table. Typically we speak over the microphone for the podcast, but it's great to be with you here in front of the camera today. So I know heading into this week, Brian, markets were looking for a catalyst to trade on. That came in the form, as I alluded to economic data spanning inflation, retail sales, jobless claims. We'll cover it all, though I do want to begin with inflation. We did receive on Wednesday CPI data for the month of July, Consumer Price Index data, and in particular, the core reading has been on the minds of the Fed and markets. So can you speak to how that data came in relative to CIO's expectations, and what does the data at this point suggest about the inflationary environment here in the U.S.?
So the data was very much in line with expectations. Another good inflation report, not quite as great as the June data, but still very good report of showing broad-based disinflation. And maybe the one summary numbers, the headline year-over-year inflation rate, 2.9%, moving below 3% for the first time since early 2021 when inflation first started to take off. And remember, we peaked at over 9%, so now we're below 3%. And if you look over the last 100 years, inflation has averaged 3%, so we're right in line with that very long-term average. The thing is, though, that I think there's still a perception that, well, prices are very high because we had that higher inflation since the start of the pandemic, and you get still the sticker shock of your favorite chips, or maybe you go to buy a car. It seems very expensive. Also, the fact that interest rates are high, so housing, the monthly payment, if you want to buy a house, it seems very unaffordable. Same if you're buying a car and financing it. So there's, I think, still a general sense that things are expensive, but the inflation rate, as economists look at it, has come down to quite a moderate level.
So Brian, as you alluded to, the fear of price sticker shock, my gas station is very busy, my grocery store, you see a lot of foot traffic, and you wonder if there's a correlation between the drop down in inflation with the rise in retail sales, which we did witness today. It did smash expectations, and as we're speaking right now, markets are reacting favorably. So how would you describe the health of consumer spend here in the U.S. based on the retail sales data we saw today?
So we did see quite a significant upward surprise in the retail sales data, but there were some downward revisions to prior months, so it's not quite as strong as it seems. And from a big picture perspective, I'd say consumer spending is holding up pretty well. This is our big fear in terms of downside risk for the economy, is that consumers have used up the excess savings that was built during the pandemic. Savings rate is very low. You see signs of financial stress like rising delinquencies on credit cards, things like that. So my biggest worry is a pullback in spending, but as the retail sales data showed, and also we're in the middle of earnings season, and the retailers are saying consumer spending is holding up pretty well. So far is so good, but again, I think there is a risk that no matter how good the data is up until today, tomorrow we may start to see some weakening because we've been through a period where spending is growing faster than income, and that can't go on forever. So at some point, the savings rate will have to come back up. People need to save for retirement and things like that. So we're waiting for that other shoe to drop, but at least so far, the most of the economy is consumer spending, and that has been holding up.
So with respect to the integrity of the labor market, that of course being another component the Fed tracks very carefully. Of course, we've already covered inflation. Today on Thursday, we did receive weekly jobless claims figures. We will have another labor report before the upcoming September FOMC meeting. So looking at the labor market overall, how would you describe it right now?
So the labor market, it's an interesting situation where the labor market has been softening for the last 2 years. We've gone from extremely overheated to now more or less in balance. And you could say, in an absolute sense, the labor market is still strong, but every aspect of it is continuing to soften. So you see the payroll growth is slowing, wage growth is slowing, and job openings have come down a lot from the peak. So everything is trending softer and softer, but still a pretty good situation. And we did have a scare 2 weeks ago. The jobless claims blipped up, and we thought it was just noise in the data, and it turns out that was right. So they've come back down. From a historical perspective, claims are still really low. It's an indication that companies aren't laying off workers. So what's happened recently is that hiring has slowed down. So companies have filled in their open positions, and they're not hiring as much as before. But we don't see a lot of layoffs, and that's helping to keep things like jobless claims low.
And it will be interesting to see what the August employment report delivers in just a few weeks' time. So at this point, the big question becomes, given the latest round of data we received today, yesterday, does the Fed at this point have a green light to proceed with rate cuts at the upcoming September meeting? So Brian, can you speak a bit to what CIO's expectations are for monetary policy, namely rate cuts, as we make our way through the balance of 2024?
Sure. So there's basically two scenarios for the Fed rate cuts. One scenario is that the economy holds up well and inflation is coming down gradually towards the Fed's target. That's a situation where the Fed is going to cut rates at a very gradual pace, probably 25 basis points per quarter. So every other meeting, they'll trim rates 25 basis points because, as long as the economy is holding up, no need to really get aggressive on the cuts. But the other scenario is where especially the labor market starts to look scarier, and we have seen quite a significant rise in the unemployment rate, which for any central bank, starts to ring alarm bells. This is, a quite worrying situation where you have rates in restrictive territory and the unemployment rate is, continuing to rise. So if you see further signs of weakness in the labor market data, especially a further rise in the next, labor report, further rise in the unemployment rate, the Fed could cut more aggressively. They might cut 50 basis points to start off with in September, possibly cut up or continue with, larger rate cuts.
Sure.
But if the economy is holding up well, labor market is good, consumer spending is holding up, they're more likely to cut at a very gradual pace. So, our base case is 100 basis points by the end of the year, but could easily be, more than that or less. All depends on how the data comes in.
Well, it sounds like that August labor report will be critical, so do look forward to covering that with you in just a few weeks. But Brian, thank you for joining us here at the table for this health report of the U.S. economy. It was great speaking with you, as always.
Thanks very much.
For more information, visit ubs.com/views. Make sure to follow UBS on social media, including LinkedIn, Facebook, Instagram, and Twitter. And be sure to check out UBS Trending on Instagram for content you can't find anywhere else. And as always, if you have any questions about your portfolio, please be sure to speak with a UBS financial advisor. Until next time, I'm Dan Cassidy. Have a great rest of the day, and remember to keep your eyes on what's trending.